Leister. Our webinar today is Paycheck Protection Program, What to Expect During the Next 8 Weeks. This webinar is our 9th webinar in a series of COVID-19 programming we are working to bring to our membership and our community. Topics that we've hosted have varied from the CARES Act to health and wellness as we work in a remote environment. Our webinar series has been a collaboration with our regional chambers of commerce, NEPA Alliance, and Lesson Alive. I'd like to recognize our chambers of commerce that are participating, and they include Wilkes-Barre, Greater Pittston, Greater Carbondale, Greater Hazleton, the Chamber of the Northern Poconos, Back Mountain Chamber, Wyoming County, Pike County, and Schuylkill Chamber of Commerce. This webinar is being recorded and will be posted to the Chamber's resource page following the conclusion of the webinar, and that can be found at www.scrantonchamber.com/important resources. The question and answer function will be enabled following the formal presentation. At this time, I'd like to give a bio of our presenters. Our presenters today are Jeff Mesko and Dan Marks of Drucker and Cicchetti. Jeff received a Bachelor of Business Administration degree from Temple University, where he majored in accounting and finance and graduated magna cum laude. He received a Master's of Taxation degree from Villanova Law School Graduate Tax Program. He is a member of the American and Pennsylvania Institutes of Certified Public Accountants. In 2004, Jeff joined DNS as an intern and quickly advanced in his career. In January of 2009, Jeff became the youngest managing associate at DNS, and in January 2012, became a shareholder. He splits his time between Philadelphia and Scranton offices and is a member of the firm's executive committee. Dan Marks holds a bachelor's degree in business administration with a concentration in accounting and finance from Drexel University. He holds a master's of taxation degree from Villanova Law School Graduate Tax Program, where he was awarded the Bartley Medallion in recognition of outstanding achievement in the discipline. Dan joined DNS in 2013, and he has since developed a broad knowledge of tax, business, accounting, and financial planning issues, becoming a shareholder of the firm in 2020. At this time, it's my pleasure to introduce Jeff and Dan.
Good morning, everyone. Thank you for joining us. We appreciate the introduction. We do want to leave some ample time for question and answer. So we'll try to go through these fun slides as quick as possible, but also, make sure we take enough time to focus on the nuance and the complexity of the forgiveness piece of the Paycheck Protection Program. Okay, the Paycheck Protection Program, what to expect during the next 8 weeks. We'll go over an overview and a timeline on the next slide in our agenda. We'll go through forgiveness qualifications, the unforgiven portion of the loan, AICPA recommendations to Treasury, given that there are so many questions unanswered. There's also a debate on deductibility of the expenses that are funded with the Paycheck Protection Loan. And then there's some other CARES Act provisions that interact with the PPP, and also ones that are exclusive of the PPP that we wanted to make note of during this presentation. Okay, overview and timeline of the funding. Round one, I think we've all heard of. The approvals went through April 16th. There were 1.6 million loans initiated. 349 billion was lent. Round two opened on April 27th. That is still ongoing. 2.4 million loans so far. 189 billion lent as of May 10th. This program is capped at 310 billion. Loans are still available to companies, sole proprietors, independent contractors with less than 500 employees. And basically the simple calculation of the loan is 2.5 months worth of payroll costs is the basis of the loan, and that loan can become a grant if certain thresholds are met, which we'll go through. One item of note that we wanted to mention was there's been a lot of publicity about public companies receiving the loans and other companies that the Treasury Secretary has indicated should not have applied for this loan, and that it really wasn't intended for companies or organizations that have adequate cash reserves or access to capital. So they announced that you have until May 14th to consider whether or not you should return the loan to the Treasury. If you do so by May 14th, there will not be any penalties for a number of both civil and criminal penalties that are associated with the application. It's important to really take a look at a financial projection and develop a narrative to support the fact that if you have this loan that you really needed it, in case the SBA or Treasury audits your records to then prove that you needed it. They did mention, Secretary Mnuchin mentioned that any organization receiving a loan of $2 million or more would definitely be audited. So again, it's just important to have that narrative, have that financial projection prepared now before the deadline of May 14th, even though there is no additional guidance on how you determine if you needed it. I think it's more of a smell test, and that should be done before Thursday.
And just one item that I'd add, good morning, everyone. This is Daniel Marks, is that you should be making that determination as of the time you applied for the loan. While you can't necessarily ignore all the facts that occurred post-loan application, you make the certification at the time that you applied. And that's when you should be considering the factors of relative to whether or not you needed the loan.
Thank you, Dan. So now we'll transition into the post-loan considerations. Basically, there's an 8-week covered period to track and spend your PPP funds. The trigger point for that 8-week period is the date that you received the money in your bank account. Not when you applied for the loan, not when it was approved by the SBA. It's actually the date that you received the dollars in your account. From that point, you have 8 weeks to deploy the money and spend it in accordance with the CARES Act.
Yes, and one of the items of debate before we move on to the next slide right now is currently the costs incurred and payments made, which is noted at the bottom of this slide. It is currently unclear what the intent was. Some believe it may have been a drafting error. Some believe that they're going to clarify and specifically describe what they intended. But the issue remains that in the accounting realm, incurred and paid has a very specific meaning, and no one really knows what their intention was. There's many schools of thought around this, but simplistically, we believe that the intent is that any amounts that you would normally pay during the 8-week period are what you're tracking, and that you wouldn't accelerate expenses that would otherwise normally fall out of these 8 weeks into the 8-week period. And then the only item that wasn't touched on this slide that will be touched later on in the presentation is just to keep in mind that June 30th is also an important date, because there is a period within which you can cure any of the forgiveness issues, which we're going to discuss shortly. For forgiveness, what qualifies to be forgiven? So any of you who've attended presentations on the PPP loan to date We'll note that there are available uses for the loan, but not all of the available uses can be forgiven. And we'll address that in this slide and then the next one. So at this point, everyone's familiar with what payroll costs are. This slide is included as a refresher for everyone. It includes, your gross salary, cash tips, vacation pay, allowances for dismissal separation, unemployment compensation, premiums paid by the company in Pennsylvania. It's your Pennsylvania unemployment compensation tax filing. Any retirement benefits that you're paying for your employees, and then health insurance. But wages do not include any wages that would exceed $100,000. So in keeping in mind that we're only looking at the 8-week period, that means wages of any individual that would exceed $15,384.62 will not be counted as payroll costs and eligible for forgiveness. In addition to payroll costs, we have what we'll call other eligible expenses for forgiveness. And they're outlined here on this slide for you. And they include 3 broad categories, not broad, very specifically identified categories, apologies. It's interest on covered mortgage obligations, what's known as covered rent obligations, and covered utility payments. And an important item to remember about all 3 is that they must have been in existence or incurred on or before February 15th, 2020. And the intent of that is they did not want businesses to go obtain this loan and then add these additional charges to have them forgiven on the government's dime. And it's important to note at the bottom of the slide, what's excluded, the 2 items noted here are uses for the funds that you're allowed to use the money for, but they are not forgiven. And again, it's still unclear if this was a drafting error, but we're just laying out the law as it's written currently. So many businesses continue to pay for their healthcare benefits for their employees while they are out on, if they've been furloughed or laid off or whatever the case may be, they continue to pay their healthcare expenses, and specifically the healthcare premiums. They are not eligible for forgiveness. The other item is interest on any other debt obligations that were incurred before February 15th. So that brings me back to the covered mortgage. It's very specifically identified, and there are 3 items that are noted in the definition. It has to be a liability of the borrower. It has to be a mortgage on real or personal property. So think not only the real estate of your business, but any of the assets that are security for a mortgage. And it has to have been incurred before February 15th. And a final note on that, it's only the interest portion, not the principal. So now that we know what qualifies for forgiveness, and most of the businesses can probably get an idea of what they need to start tracking, on the back end, once the 8 weeks are up, there are 4 tests that limit the amount of forgiveness that you can be eligible for. And we'll go through each one of them on the coming slide. An important item to note up front, while there are 4 tests, there is still no guidance on in what order they apply. So hopefully that will come from the Treasury sometime this week. Unfortunately, we've been saying that for the past 3 weeks, but maybe this one's the one. So the first test, the forgiveness cannot exceed the amount of the original loan principal. That sounds like common sense, and it is. Unfortunately, large amounts of this CARES Act sometimes have defied common sense to this point. But we wanted you to know there is no tricks relative to the forgiveness can't exceed the original loan principal amount. Test number 2 was inserted not by the law, but by regulations. And test number 2 deals with that 75% of your 75% of the forgiveness that you request must be expended on payroll costs. So To give everyone an idea of what that means, we just gave everyone the shortcut here in the first bullet item, which is determine what your payroll costs will be over the 8 weeks, or estimate them, begin to estimate them now. You'll divide that amount by 75% to determine what your loan cap is for the overall forgiveness. So for example, if I had $75,000 of payroll costs that I expected for my 8 weeks, and I divided that by 75%, that would give me a total eligible loan for forgiveness of $100,000. Remember that your loan could be used for payroll costs, the $75,000 in this example, and you could use it for other eligible expenses. That's what the $25,000 amount, the differential between the $100,000 and the $75,000 represents. One last item on test number 2 is that obviously if you do that math and the math gives you an amount in excess of the original principal of the loan, you're still limited to the principal. It just means that you have less to spend on the other expenses. Many businesses that we're seeing are actually trying to do 100% payroll to avoid dealing with the other expense issue and to ensure that they attain the 75% required. Test number 3 is based upon a change in your full-time equivalence. One of the issues that we currently have around this test is that full-time equivalents have still not been defined. We will address a recommendation by the AICPA later, but there is no definition. Our recommendation at this time would be that however you determine your full-time equivalence, to do it consistently throughout the application of this test. So the test compares your full-time during the 8 weeks post-loan to 2 different periods. So there are 3 things you need to determine here. One is your full-time equivalence during the 8 weeks. And then you're going to compare that to one of 2 different periods, and you can choose the period that gives you the best answer. The first period is February 15th, 2019 to June 30th, 2019. And the second period is from earlier this year, January 1st, 2020 through February 29th, 2020. To determine what the reduction is, and when you read the law, it is very unclear, but we wanted to give you this shortcut. The potential reduction from this test is equal to what is your total forgiveness that you determined in via tests number 1 and 2. And you're going to multiply that by the ratio of 1 minus the 8-week post-loan period, the full-time equivalence, divided by the other period that gives you the best answer. And the one that will give you the best answer is the one that gives you the least number of full-time equivalents in relation to the 8 weeks. An important question that was addressed this late last week was, what if I attempt to rehire someone and they won't come back? This is an issue that we see many businesses facing right now because unfortunately, just the way the CARES Act was enacted and with the rush, many employees are actually doing much better on unemployment than they are coming back to work. So what the unofficial guidance the Treasury issued last week via their frequently asked questions is that if an employer makes an offer in writing to their employees to rehire them at the same wages they were earning before in the same hours, and the employee denies it, you do not have to include them in this test. We still don't know how that will work mechanically in terms of how the math will work, but just know that if you're concerned that you received this loan and your employees will not come back, that if you can demonstrate that you tried to rehire them and that they would not come back, that they won't be included in this test. And that brings us to our final test, which is based upon salary reductions. And I just want all of the participants to understand this is the likely the worst defined provision relative to the forgiveness. And we're going to give you our 4-step process, or one 4-step process by which you can analyze and determine this. Another important item to remember relative to this test before we even look at the steps is that this analysis is performed on an employee by employee basis. It's not done in the aggregate for all of your employees. So what the law tells us to do is to begin by reviewing our 2019 wages and identifying employees who made less than 100,000. As a shortcut, we suggest that you look at the Medicare wages, which are usually the true cash wages of the employee, to make that determination. Moving on to step 2, for employees that you identified in the first step, was the employee employed on the date you obtained the loan? I want to caution everyone that, again, this is one interpretation. Another interpretation is that you need to look, were they employed on February 15th, which is a date referenced throughout the law. There's multiple interpretations. We're just giving you one so that you can get an idea when you run this for your personal company. Step number 3. If yes to number 2, if the employee was still employed on the date you received the loan, you're going to need to determine the average weekly wages for that employee for the last full quarter of wages that they worked. And then you'll multiply that average by 8. And what the goal of step number 3 is to determine what would that employee normally make during an 8-week period. And the law of reference is the last full quarter of wages. So hypothetically, if someone didn't work all 13 weeks of the first quarter, but normally would have, then you may have to go back to the fourth quarter of 2019. We expect further clarity on this. Finally, after you've determined what the employee would normally make during an 8-week period in step number 3, step number 4, you compare what they normally make to what you expect they will make during the 8 weeks. Obviously, you may be doing this test after the fact, so you'll be comparing it to what they actually made during the 8-week period. If their salary was reduced by more than 25%, your forgiveness will be adjusted downward for any amount in excess of the 25%. To cut through the complexity, the end result of this test is you can hypothetically reduce your employees' salaries by no more than 25% during the 8-week cover period. So an interesting question is posed at the bottom here, which is the loan recipient penalized by both test number 3 and test number 4? And not only that, but in what order do they apply? We do not have any answers. It seems the intent of the law was that they wanted to keep people employed and introduce test number 3, but after introducing test number 3, they realized employers could choose to keep everyone to not be harmed by the reduction, but cut their salaries by, for example, 50%. So then test number 4 was introduced. Again, this is just one opinion, and additional guidance should answer the question.
Given all that, there's still a ton of uncertainty out there, as Dan noted, and the law does mention what we call a cure period for the forgiveness. So according to the law, even if your forgiveness amount is reduced by a reduction in the number of employees, full-time equivalents, or wages, the reduction can still be cured by June 30th. We don't know if that means it can be cured by June 29th, one day prior to June 30th, or if it will be prorated between the 8-week period. And again, waiting on future guidance for this cure provision. It's important to note that they did mention in the law that costs both incurred and paid are eligible for forgiveness. So we don't know if that means you can't bring someone back on June 15th and pay them back pay for 6 weeks and catch up that way because their salary wasn't incurred for that whole period. So that's a a couple of words in the statute that we're really hoping for some more clarity on.
That leads us to, once you've gone through the tests, you determined your eligible forgiveness, what's remaining, you may be left with an unforgiven portion. For the unforgiven portion, that remains a loan. Regardless of the unforgiven portion or not, your payments are deferred for a 6-month period, but interest continues to accrue during that 6 months. The end result of at least how we've seen the banks interpret this in their documents is that the banks are interpreting that the loan begins the date it's funded, despite the fact that you do not actually know what the amount of your loan is until 6 months later, because hypothetically, by that point, you have already applied for your forgiveness and know the actual amount that has been forgiven and thus the remaining outstanding amount. The end result is that the unforgiven amount and interest are actually payable back over an 18-month period instead of 2 years. The law, reads a little differently. So we're unsure if additional guidance will change the bank's opinion in this and whether or not they would revise their documents accordingly once the forgiveness amount is determined to adjust for a full 24 months, as opposed to the 18 that we've seen in almost every single loan document. It's also important to note that there's no prepayment penalty, meaning that if within that 6-month deferral period you determine the full amount of the loan is not forgiven, and maybe you didn't spend the full amount of the loan, and thus the amount that you didn't spend you still have sitting as set aside, you could choose to pay it back immediately. There's no prepayment penalty, and thus you don't have a loan over the remaining 18 months. And it's important to remember that the interest rate on the loan is only 1%, making it, at the end of the day, fairly cheap capital for any business. As you've seen in what we've described, there's many inconsistencies that don't necessarily align with the intent. And we were hoping that before this presentation today that we'd have additional guidance, but we do not. And the hope is that many of these items will be fixed with additional guidance. And that leads us to the AICPA recommendations. We have to say that the AICPA has really been a friend to the profession and a friend to businesses of all sizes throughout this process. They helped clarify many items and worked very closely with the Treasury and with Congress when applications first opened. And when the applications first opened, there were many questions regarding taxes and whether or not they were included in the calculation and a host of other issues. And the AICPA was very helpful in getting to the bottom of that quickly and helping Treasury issue guidance on that. And they're trying to do the same thing here on the forgiveness side. And now we'll go through what those items are. So their first recommendation is to align the beginning of the 8-week covered period with the beginning of the loan recipient's next pay period. That way it would allow a business to optimize the number of pay periods that they could fit within the 8-week period. I will give you my opinion here. I don't think this will be changed, given that Treasury has issued guidance multiple times to indicate that the 8-week period begins upon receipt of the funds. But, it could. The second recommendation was to begin the 8-week covered period when operating restrictions are lifted, rather than the date the loan proceeds were received. This recommendation makes significantly more sense to me because there are certain businesses that obtain the loan only to later find out that they're still not opening. Many businesses thought they would be reopened in May. Many states have extended through at least June the stay-at-home orders. So my crystal ball is broken relative to all of these things at this point, but this recommendation would make significantly more sense to me that this would somehow work its way through than the original one, because this only applies to a subset of businesses, whereas the first recommendation, a certain subset of businesses that are hardest hit by the impact of COVID-19. Whereas the first recommendation applies to all businesses and potentially could be abused, even though businesses can change their payroll period as they choose to. Third recommendation deals with how to define a full-time equivalent employee. Again, it is not defined in the law, and the AICPA recommended using the definition from the Affordable Care Act, which many businesses are accustomed to and aware of. And that's based upon if an individual works more than 30 hours in a week, they are considered one full-time equivalent. For anyone that doesn't meet that definition, you aggregate them together for a month and you divide that amount by 120 hours to determine how many full-time equivalents all of the part-time people equal. The fourth recommendation actually deals with how we presented test number 4 to you in the limitations. The way the law currently reads is that you compare an 8-week period to a quarter. Well, obviously an 8-week period is 8 weeks, and a quarter is typically 13. I apologize for the typo in the slides, but a quarter of the year is normally 13 weeks. So when you're looking at the two, the math just doesn't work. 8 weeks is naturally going to be less in an amount of time, and thus everyone would have a reduction in salary simply based upon the number of weeks included in both periods. And as indicated, we anticipate guidance. I checked multiple times this morning, even before our presentation, and nothing else was released this morning.
Thank you, Dan. That leads us into the next part of this debate, which is, are the expenses that you pay with the PPP loan tax deductible? The IRS has come out with a notice number 2020-32 on April 30th, indicating that expenses that are funded with the PPP loan are not tax deductible. Many believe this undermines the intent of the CARES Act by working against companies' liquidity, employee retention, and recovery. One item of note is that the CARES Act explicitly states that PPP loans that are forgiven are considered non-taxable income. Normally, when a liability or a debt is forgiven, that is taxable income. Notice 2020-32 makes the expenses paid with that loan basically taxable. Because the payment of the qualifying expenses will be forgiven but not tax deductible, the liability for income taxes will likely need to be increased on a company's balance sheet and tracked. And these expenses right now that organizations are funding with the loan should be tracked separately so that when you go to do your 2020 tax return, those items can be identified and, as it stands right now, added back to your taxable income. There is bipartisan support to amend the CARES Act to allow for the expenses to be deductible, but that, to my knowledge, has not moved too far down the road yet. Just a little bit more on the non-deductible expense debate. It is an IRS position in the notice that they issued. IRS notices are not actually law. That's their interpretation of the law. So this will undoubtedly be a subject of litigation in the future if they don't change it. Couple of other considerations and interaction with the PPP. Payroll tax deferral of the employer's portion of Social Security tax on wages paid between March 27, 2020 and 12/31/2020 is possible through the date the lender issues a decision on loan forgiveness. So there was some uncertainty around that because it is known that if you're a recipient of a PPP loan and that loan is forgiven, you're not eligible to take advantage of the payroll tax deferral. You can still take advantage of that deferral up until the point where the loan is forgiven, which may be 6-9 months from today. We don't know. That depends on your 8-week period and how long your lender takes to review all your records and review the loan forgiveness applications. The deferral is it has to be paid back in 2 years. 50% of it is paid back at the end of 2021. The remainder is paid back at the end of 2022. EIDL loans remain available. This is another SBA program for businesses with less than 500 employees. These loans do have a $10,000 emergency grant available. Caveat here is you can't take an EIDL for the same purposes as a PPP loan. You have to have a different purpose for it. There's another program from the Federal Reserve called the Main Street Lending Program. New lending program offered by Treasury to businesses with up to 15,000 employees that was rolled out on May 1st. That has a much larger limit to the amount of a loan you can obtain. And I understand that loan has a 4-year payback period.
And it functions as a traditional loan. There is no potential forgiveness of any sort associated with it.
Same goes for the EIDL loan. That's a traditional loan also. Some other things that businesses should consider that were rolled out with the CARES Act. There's an employee retention credit. This is not available if you obtain a PPP loan, but serves as an alternative by providing credits up to $5,000 per employee. What is known as qualified improvement property was fixed. This is basically interior improvements to any buildings, warehouses, factories, commercial property. Those improvements that were made in 2018 or 2019 can be depreciated over 15 years now. That would make it eligible for bonus depreciation, which allows a 100% federal tax deduction. It also allows one to amend their tax returns to take advantage of this incentive. One might consider coupling that with a cost segregation study or an accounting method change to basically accelerate a large deduction into 2018 or 2019, depending upon when the improvements happened. And then these other two items are also sort of intertwined with that. I'll go through them. The excess business loss is delayed. This provides the opportunity to amend 2018 tax returns to create net operating losses to potentially carry back to prior tax years. No interaction with the PPP. Net operating loss carrybacks are again available and can be carried back to other previous tax years, which will allow for potential refunds on your personal or corporate tax returns. So with the qualified improvement property, accelerating those deductions may be able to allow you to take that tax loss backwards and get a refund in prior years where you did pay taxes. So these are some of the items that are out there that can be really valuable that aren't related to the PPP loan.
And just one important item to note that we did not include on this slide that was clarified recently is that say you obtain the PPP loan and then you determine that you decide not to keep it and return the funds by May 14th, you still remain eligible for the employee retention credit. Just by the fact that you were approved and received the loan does not negate that you can take those credits if you then decide to return your PPP loan.
And we understand that the second quarter payroll tax returns will be updated and changed to allow for a mechanism to take advantage of that employee retention credit.
Yes, a draft was issued this week of that. So your payroll companies should be up to date on that at this point. So at this point, we're happy to take any of your questions. Thus far, we've only received one regarding full-time equivalent changes. Are we penalized if someone voluntarily resigned a position in early March and we have not filled this position yet? So the issue with that question is that we don't know. It's one of the items that we hope to be clarified. Based upon the presentation we provided you today, we assume that that person, if that person was not an employee at the time that you received the PPP loan, that they would not be included. So if you take that interpretation, they're not in the test at all. But we're waiting for further guidance from Treasury. Our hope relative to the delay in guidance is that, unlike all of the other guidance that they have issued to date, we hope that they are taking their time with this to not create more questions than provide answers. Unfortunately, to date, every time they have issued guidance, they have created more questions than they have answered. So we're hopeful that this delay will produce something more usable for everyone and easily understood. Someone asked the question of, please define the allowable expenses of transportation and telephone. Again, we're waiting for further clarification on that. The only clarification, and it wasn't a clarification, it's reading between the lines, for transportation was on the regulation that dealt with self-employed individuals. And in there, they mentioned expenses for a vehicle, gas, essentially, for a vehicle for a self-employed individual. That is literally the only hint we have at what transportation could mean. Telephone is exactly that. It's the expenses for your telephone line for your business. Previously, medical insurance premiums were to be considered forgivable, correct? Was this a last-minute change? So nothing has changed relative to medical insurance premiums being considered forgivable for current employees that are working and being paid. I think what may have caused confusion during the presentation is that if you've laid off your employees and choose to continue to pay their health insurance, those premiums are not forgivable. I'm just going through the questions here. A question for you. For the employee retention credit, is the credit a payroll credit? Jeff, are you there?
I'm here, yep.
Yeah, for the employee retention credit, is the payroll credit, is the credit a payroll credit is the question.
Is the credit a payroll credit? Yes. It is a payroll tax credit on the employer portion of FICA taxes. It's available. Again, if you don't obtain a PPP loan, you're eligible for this. And basically, it's structured as 50% of the first $10,000 of wages per employee. And as we referred to earlier in the presentation, the mechanism for obtaining this credit will be reflected on second quarter 2020 payroll tax returns.
If you own a hair salon and one employee wants to stay on unemployment, are you penalized for this? So based upon the guidance that was issued by Treasury this past week, no. As long as you offer that employee to come back at the same wages and at the same rate in writing, and they deny it, they will not be counted against you. The issue is if your loan was based upon having that employee and now you don't have that employee, you're likely going to have funds that you can't spend during those 8 weeks. So you may have to repay that portion of the loan back. A question for you, Jeff. Who will be making the forgiveness determination? Will it be the banks?
It is the banks with the supporting records that you provide to them. I think we have a checklist, right, Dan, that we're going to provide as part of this, a checklist of what we would include with your forgiveness application that you send to your lender.
That's correct. As part of attending today's presentation, in addition to the slides being posted, there will also be a checklist for everyone that they can use to help them begin gathering the information that we anticipate the banks will need. Both we and the banks are still waiting for official guidance to determine what exactly will be needed. Another question, can you please clarify whether payroll bonuses will be allowed during the 8-week period, provided the employee remains under the $15,384.56 for the period? This gets back to the paid and incurred issue. We're unsure at this time whether or not bonuses will be included. We would think that if normally during the 8-week period is a time where you would bonus your employees, that would normally be incurred at that time. But we would recommend that you work closely with your advisors and hypothetically project out situations with and without those bonuses to see whether or not they're truly necessary. Jeff, do you have anything you'd like to add there?
Sure, there may be a good business reason, a good business purpose to compensate your employees with bonuses. They could be working in sort of a hazard type of environment. There could be a lot of circumstances given the pandemic we're in right now where that type of extra pay really makes sense. So I think if you put some business purpose around it, it will likely stand up to scrutiny that a bonus is allowed.
Great. Does the owner's payroll, who are full-time employees, is that eligible or counted under the payroll forgiveness? So for that question, it depends on the type of entity that you are and the analysis, how you perform the analysis. So if you're taxed as a partnership, or if you're a self-employed individual, which partners in a partnership are, then the law provides for something known as owner compensation replacement, which is equal to 8/52 of your 2019 self-employment income, which for a business is reported on their 2019 Schedule C, line 31, And for a partner in a partnership would be reported, I believe, in box 14A on their Schedule K1. Now that amount is limited to, the same 100,000 applies there. So the maximum that you could have as owner compensation replacement is 8/52 of $100,000, which equals that same $15,000 number that we referenced during the presentation. But yes, owners are eligible as well. And if you're formed as an S corporation, it would just be your normal W-2, similar to all of your other employees. Another question regarding the health insurance and when it's included and not. Again, the distinction is whether or not you're paying the premiums for people who are still employed versus people who are unemployed.
So it is included if you're still employed.
That is correct. Jeff, a question for you. What effect will bringing back seasonal employees after PPP funding have on our loan forgiveness?
Hard to say right now. I think it can be more of a business decision instead of a PPP forgiveness decision. I mean, hopefully there's more and more guidance that comes out. We keep waiting and saying that. And as Dan said, hopeful that they're actually taking their time to provide clear guidance. But I mean, if you're a recipient of a PPP loan and you can't really deploy those funds yet, it may be a business decision of just turning it into a loan and having 2 years to pay it back with a 1% interest rate. Anything to add, Dan?
Yeah, I agree with all your comments. I don't know that much to add aside from whether or not what could impact things is whether or not those employees were employed sometime during the first quarter of the year and then you laid them all off, then you would definitely want to bring them back as to not reduce any forgiveness that you're eligible for. So that would be the only caution I would have there. But I think at the end of the day, it is still a business decision. I'm just scrolling through the questions. For the salaries test, what if the hourly wage for the employees is the same as it was in the look back period, but business does not warrant scheduling the same number of hours? Would we have to pay them for hours they have not worked? So unfortunately, there's no clear answer to that. The issue is that the third test is strictly looking at what were they paid versus what do they continue to be paid. So you may have to retool or their job requirements and potentially increase their hours, at least during the 8-week period, if you're worried about maximizing forgiveness. But again, I think it's important to remember that let's not let the forgiveness tail wag the dog. If you don't have the business for them to do the work, then you can just pay back the excess funds that you received and not have a loan. So I think it's still a business decision. Jeff, do you have anything to add?
I guess I'll add that you can reduce their salary by up to 25% during that period. You have that bogey of 25% to play with before it will impact your forgiveness.
Thank you. So Jeff, do you want to speak a little more to hazard pay? We have a few different questions regarding and around the hazard pay.
Certainly. So I think the context of that question was, can I pay, bonuses, if you will, to my employees that aren't making more than $100,000? And unfortunately, there is uncertainty there because of the incurred and paid language that we find in the CARES Act. But I think if you're going to take that position, it's better off having a business purpose for doing it. Like we have companies that are in the medical field right now, where they're doing, say, COVID-19 cleanup, where they're cleaning facilities, and they're doing different things that are COVID-19 related. In my mind, that kind of risk that employee is taking, if you will, is worthy of additional pay. And that is actually, if it's paid and incurred during that period, it should be allowable. It's taking a position because the law isn't clear, but again, I think it's coupled with a business purpose behind it is much better than just saying I can do it. Dan, do we have any other types of industries where that's coming into play?
I think mostly we've only seen it in healthcare. I would think that if it may be reasonable that a restaurant, for example, that decides to remain open and do takeout only, or their delivery drivers or something like that, maybe possibly they could be included in that, I would think.
Or some sort of product, right, that everybody wants right now.
Correct.
It could be like hand sanitizer or something like that, where everyone needs, and people are kind of leery of working in an enclosed setting. I think that makes sense to sweeten their pay during this period, and it can also be helpful with loan forgiveness.
So another question, are health and retirement benefits paid for business owners eligible expenses for forgiveness? And that depends, unfortunately, on the type of business that you are. This is something where they've, again, unintentionally, which we've always seen throughout tax law, not, you get different results dependent upon the type of business that you are. And for an S Corp owner, for example, their health and their retirement, the normal retirement, matching contributions, so on and so forth, if you have that in your plan, they would be included. But the one area where they were very specific that it is excluded is for self-employed individuals. You do not include the health insurance and the retirement for someone who files a Schedule C. Just catching up on the questions here. Thank you for your patience. I think that pretty much wraps up all the questions. I think we've addressed all of them. If anyone has any one final question they'd like answered, they can submit it now. Otherwise, I think we've completed everything. So I'll turn it back over to.
And I'll just say we have a COVID-19 Tax Resource Center on our website that will continually provide updates to all of this.
And we highly recommend that you visit our website and see blogs that address many of these nuances and many of the issues. And there, even at the bottom of the blogs, you'll find a lot of questions from other business owners that you may find the responses are helpful to your specific circumstances.
Okay, great. Jeff and Dan, I'd like to thank you for bringing us our presentation today, and thank you for everyone on the call. I wanted to highlight some of upcoming webinars we have this week on Thursday, May the 14th, we have at 9 o'clock returning employees to work after COVID-19. And then on Tuesday, the 19th at 10 o'clock, we're going to be doing business disruption insurance. All programs and events could be registered at the scrantonchamber.com/events page. And hope to see you later in the week. Thank you.